The following. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi, everyone. Basil Chapman. Good to be back after planning to be here earlier. And then there was a 7-hour delay, but flight was safe and we're here. So let's go on straight to the market. Dow's down 50 at 20,650. Let me just show you this E-mini for those of you looking at Tiger TV. This is the 2-minute E-mini chart. Went to a peak A, then A, restart, B, C, D, E, and then an F. MACD stochastic turned down, peak F top. We've pulled back, held the, I think this is the 50. Let me just double check. I've got these moving averages here. Yep, that's the 50. Dashed line support, trying to hold. We'll talk about the market in a moment. Let me just quickly say that it's good to be back. I really missed being here. I missed doing the show. It's amazing how much, what is it? How many years? 2003, I believe it was. So, yeah, good 13, 14 years we've been doing this every week, every day, just about of every week. And so you kind of miss it. Gets into the blood. 120-minute chart made a peak D. Remember, whoa. We'll talk about peak D. It's been a little while since I did that. Let me get to it. There we go. One step at a time. Right there. Okay, I wonder if I've still got the chart. Let me just check it out. Move that other computer away. Now, can I see them all? Yep, there we go. Yeah, we go. So this is the one. Oh, I lost it. All right, it's gone. I just had too many charts while I was away. All right, what was the objective? The objective is to make 4 higher peaks of significance. There you've got a peak in the 120-minute chart of the E-mini, the June E-mini, 2317.75 was the low on Monday. The 27th at 4 o'clock. Have a retest at 2318, round number high, 4 bars later. Successful test, and it spirals up to a peak A right there at 2341.50 at 4 o'clock on the 27th. Pulls back a little later on that evening at 8 o'clock. It goes to, on the 27th, it goes to 2342. That's peak B. Then it goes to peak C right there at 4 o'clock on the 28th. Pulls back quite sharply. And it then has a spiral to the upside. Remember, that was that reversal. It went to the upside, and we go to 2360.50. That was yesterday with a high at 4 o'clock. And we've gone sideways through the evening, then a little bit lower, a little bit higher. And we're in that rectangle. What I said to my subscribers in my opening call, watch the rectangle. We started this rectangle again. And you need to break above 2360.50. You really need to get to 2363. And I would have to term that at least intraday as a breakout to the upside. But now let's go through the nitty-gritties. I'm going to run the numbers. Let's run all those numbers, and then we can start to look at where are we and what are we doing. And I'll try to respond to those, just a couple of people who said, am I still looking at lower lows? And one person said, and being correct for a long time, to say, what was it? What was the expression? Let me see if I can find it. If you're not long, you're wrong. Well, we have a mixed portfolio, but we kind of weighted a little bit more to the downside, to the negative side in the indices. And this is what I'm looking at here. The Dow is, excuse me, is down 47. Let me pull the charts up. Let me get rid of the 120-minute chart. We'll go through it as if it's the beginning of the week, not the middle of the week. So we had a Chapman Wave 5, and this is the Chapman Wave technique that has as its core basis initially Elliott Wave, but since then it's broken decisively away from that. I decided to stick with the notation that I had, and I've called this Wave 3 to the downside at the low that was made on Monday at 20,412, and that this is Wave 4 to the upside with a chance that we make another U-shaped pattern and we take out that trough C at 20,412 and we start leg D to the downside, and that'll take us to 5. At that point, we should have another chop to the upside. But the theme, as I see it at this particular point, based on the weekly chart starting to fail, at a 5, Chapman Wave 5, peak G at 21,169 on the 1st of March in the daily, a peak D on that same date in the weekly, and we went under the 9-period moving average for the very first time since we broke that big spiral to the upside back in back in November. And that was a very important break to the upside. And now it's the very first time we started to test the 9-period moving average, and that makes the 9 EMA at 20,600 a very important magnet and a potential support level. But first, we have to treat it as if it's a magnet to go there and find support, which is done so far. The monthly chart is still in leg D, and all the others are in leg C. To me, that's still very bullish. Now, on the plane, I had a lot of time in which to do some. What I love to do is to go through charts using completely different methodologies. And in those charts that I went through, my monthly charts suggest that there's a really good chance that this buy mode in the monthly charts hasn't even flickered from the buy mode. It hasn't even acknowledged for a moment that there could be weakness, and that's really positive. So we'll see, and it's going to take price. It's going to take about another 1,000 points down, 800 points down, to really affect negatively the monthly charts. I mean, really affect it, not just have it slightly change from very bullish to just bullish. Now, what I'd shown my subscribers before, and the reason why we've been short is, you see these yellow, this is not a Chapman Wave, a stalk leg formation. This is something completely different. I could have used a different color. This color seemed to me to be appropriate, kind of highlights it if you're looking at Tiger TV. And what we're looking at is that each one of these corrections had a sharp pullback. It used time and some price. Time and some. This is the one from way back there. Week of the 22nd of April of last year, time and then price. The couple of weeks, number of weeks of from the August 2016 high of 18,668, breakout to the upside, and then a shorter period that was made with that high that was somewhere around December, pulls back, breaks out, and now we've had the same kind of pattern. I put the rectangle, now we're underneath the rectangle, so this is a very important period. And I suspect that we have identified a more intermediate term top. So let's leave it at that. Now let's run these. S&P right now, S&P is up 1.73 at 2360, made a peak at 2400 on the 1st of March, made lower highs and lower lows. That's what we're looking at. But it's holding quite nicely here. And if it breaks above 2369, it's at 2360 right now. No, I'd have to say 2368 to 2371. If it overcomes that resistance, I have to consider that quite bullish. The weekly chart is still quite negative. On the shorter term, it's made a peak D, sharpest pullback we've had in quite a while. So we'll come back. I'll just mention that gold right now is down 3 at 1252. Crude oil is up 70 cents at 49. Bonds are up 8 cents at 124.20. And the dollar is, if I can find it right now, is at 99.87, and that is it's up 32 cents. I'll be right back. Basil Chapman back from a vacation. Actually, working vacation. I'll be right back.
If you're looking to unearth a new financial resource and diversify your financial portfolio, consider the new market-safe core commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 4 equally weighted commodities: gold, copper, WTI oil, and sugar, in one powerful CD. With no pricing caps, you can potentially earn an unlimited upside payment at maturity if the commodities increase in value across semi-annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There's no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. With certain commodities on the rebound, now is the time to take advantage. The March 23rd funding deadline will be here before you know it. So call 1-855-750-4051 or visit everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once more, that's 1-855-750-4051 or visit everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Yes, we're back. And the question was, do I still have my hand-drawn charts from the 1970s? 1970s would have been 79, 80. Yep, I do. And I have just sitting over right there on the side of my desk. I've got this big three. It's actually folded up. It's about 3x4. I had to join all this engineering paper together because the market kept going higher. And I used the same engineer's paper, which was like one, I don't know if it was a centimeter. Each little centimeter was a point. So the scale in 1920s was the same scale I used in 1987 when we hit, what was it, 2370, what, 2327 or something on the Dow? Yeah. All right. So let's get back to our story. So we're looking at the comp index. This is a very unusual type of pattern for an index. This is a B, this is a C. And finally, we made a D in the comp index. We were waiting for that. If it doesn't make a new high this week, it's a D. And it's still a leg C in the monthly chart. But the right arm extension that was made right here at the high of the comp index, that's the broad 2,000 or more stock indices, NASDAQ stock index, making 5928.06. If you go to the NDX 100, look at the difference. Oh, I haven't finished it. This is A, B, C, D, same thing. So it's the same pattern, but I need to check, was that a high? Yes, it was, 98.43, 94.66. So we made a D there as well. So far, the action after a D has been pretty darn good. All right, let's go through this. The QQQ is really the benchmark that we're looking at, right? I've got that notated very nicely. And what happened was, right here, went to a G/C at 132.40 on the 15th of March. It double top at 132.43 and then just snuck a tad high intraday to make that D. And that D was really important. That D occurred on the 16th, is that what I said? On the 21st. So now we've got 132.43 as a high, make that 43. And I just said it was the 20, oh boy, I should have remembered that, all right? All right, And now what we're looking at is a situation, 26. No, it couldn't have been 26. That was just, let me go through this again. We're going to get rid of all that. A lot of dead time here. I'm not sure why. Maybe it's because I'm still half asleep. But this is one of the few times I've been so jet-lagged. Woke up at about 1:30 last night, or this morning, and then kind of tried to sleep hard. There we go, 121. So 321 was the high in the Qs. Okay, let's just get this out of the way. We're looking at a situation that says 321, making it as simple as possible. If we can break above 132.43, that's good. But if at any point in the next week, the QQQ series goes above 133.90, 134.20, above that, I just have to say, you know what? There is so much buying pressure that we're going to break out and go higher from here. I actually don't think it's possible. I just don't see it at this particular point. I think there is just so much evidence to say that if you go through all the different stocks, that their daily charts, so many have made peak Ds, and the weekly charts, so many made Ds. Now we're going to do this because I think it's very important. There are a bunch of things that I want to cover. I'm just looking to see if there are any. Yeah, here you go. So the QQQ series, a break into the 133s says something else is going on. A break under 131 at this particular point, we're at 131.91. A close under 131 says, no, chop to the downside. But this is going to be fascinating because if you look at the strength of the IWM over the last 3 sessions since Monday morning, this is nice action. But wait a minute, you've got to put into context. Look what happened right here. On the 21st, that was a smash to the downside. 138.60 down to 133.92. I mean, over almost 5 points, over 4 points. That is huge. And what I'm thinking is that there's going to be some kind of lower highs and lower lows just for a little while longer. Now, let me just review this once again. When I said that I went through monthly charts using different indicators, different methodologies, my contention was when I was doing it, I said to myself, that is fascinating. It's as if, sometimes over the last few years, we've seen stocks that have rallied so sharply. And I've said the monthly chart hasn't even acknowledged that there was a 3% or 5% or 8% drop in the stock because it's been so strong. Well, that's really the case with some of these monthly charts. And that says to me that at some point we're going to make a low and then we're going to accelerate to the upside. It's in this interim period here. And then over the weekend, one of the reasons why it was very difficult for me, especially since I wanted to do the show, I was actually prepared to do the show twice over the last 3 sessions, going Friday, Monday, and even Tuesday. I missed it just by a couple of hours when I finally got back to my office. I wanted to say that there are a couple of things going on that are very important. If you look at the volatility index, look at this. The VIX index made a peak D in the daily, a peak D in the 120-minute chart, and plummeted from 14.16 down to today's low of 11.03. Essentially what's happening is that Friday there was a close up with a green candle in the weekly chart, still way under the 20-period moving average of 15.63. But we have learned that the volatility index in the 12s or the 11s is suggesting that there's buying pressure. Now, my contention, based on a lot of work that I did while I was just doing nothing else but trying to analyze without having any opinion whatsoever, just trying to look at the charts and say, what are these charts telling me? What the VIX index is telling me is that there is still residual buying. Look at this. Look at the weekly chart, plummets back under the 9-period moving average. Look at the monthly chart. It doesn't even break and hold for 1 month above the 9-period moving average since it broke down since January. There's been just 1 month where that black line is a thick black line. They had one close above on a monthly basis. My thinking is that we are getting closer and closer to some kind of a rally in the volatility index that's going to try to test the 15.60s. That's the 200-period moving average in the weekly chart. And that's going to give us a clue whether or not that incredible rally that started from November the 9th has the temerity, has the power to be able to sustain pullbacks so that the volatility index constantly remains on a closing basis underneath 1416, let's say 1450 to 1510 on a monthly basis. That to me says if it does that, if all the way through April we do not close above the 15s, let's call it 16, in the 16 area on any weekly basis, that is just going to say that buying is intense and keeps supporting stocks as they pull back. And then I want to show you something that's very interesting in the currencies. I'll be back. Basil Chapman, Tiger Technicians Hour. Dow's down 47, S&P's up 1.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Peavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
They're looking at the E-mini. This is the 2-minute chart. Look at this. Peak F, pulls back, holds that 50-period exponential moving average support. MACD breaks down, stochastic breaks down, price rallies, and then comes back, but it hasn't made a low. I think it will, but in the meantime, back at the ranch, watch that H pattern. You know the rule of thumb. You close underneath that, you've got 2 bars to get back in. If you don't, you're going all the way down to the 23.53. 200-period moving average, that green line. Let's get back to our story. So the VIX index, let's make it real simple. Put it at 11.30. Starting to push into the 12s, starts to put pressure again on the market. Holding at 11.30 says that there should be buying and you can see it somewhat in the S&P, which is up 97 cents. But really, what we're looking at is look at the 120-minute chart. It's amazing how this works. VIX, did I update that? No, I didn't. All right, I'll show it to you right here. VIX index, 120-minute chart. The other day, made that peak D. Look at that. Peak, this is the overview section that I give to my subscribers every day. All right. If I can find it. All right. Well, it's right here. Overview section right here. And that explains it. You see that leg D? And what I said is that under 1250, the market rallies. And over 13.50s, it slides. So we've got the S&P rallying a little bit, and it's now down 24 cents at 11.29, the VIX index. But look at that sharp pullback. Let me show you the result. Look at that. Look at that big move. Oh, did I use that correctly? Yes. So what we're looking at, 15.11 on the peak D in the daily. Look how it plummeted down. And that really helped the market. Look at the 120-minute chart. We've gone spiraled up. You got that resistance. You're pulling back. And now we're going to see what happens. So even more importantly, look at the daily. The daily, these are the charts that I show my subscribers every day. I drawn in a while back. I drew in the up channel, and I also drew in a down channel. And what happened is we went right into that little crux right there, 20,412 on the Dow. Rallied sharply, stopped dead at the 20-period exponential moving average. And here it is, the same chart, but with the MACD and the stochastic. See, the MACD hardly budged. It was still descending, although the histogram says that it's starting to rally a little bit. Now, what's really important is that the stochastic rebounded nicely, but it went only to 28%. If it went higher, that would have been good. So I'm looking at this, and I'm thinking, there it is, making another arch formation. Let's see if that pans out. That's what I'm thinking. Now, okay, so the VIX in the low 11s shows some buying pressure. Shows a lot of buying pressure, but what I wanted to say is that the buying pressure at 11.29 should be much greater. So we've seen that the Dow is weaker than the S&P, so I'm going to be watching this closer. That means the 500 stocks are a little bit better than the 30 Dow, and I like that. Now, the weekly chart suggests that already you've got to get to 1250s before there's any real selling pressure in the Dow. Otherwise, 1220s, a point higher, and I don't know what it'll take to get that. So my thinking here is that there's still residual strength. I said I'm expecting some kind of a doji mixed close today in the market, a small candle. So now the question was, that was the VIX index. And the next question was, the VIX has yes. So Mr. Bull in the Den says, but Basil, VIX has failed at C on weekly for the past year. And I said, absolutely. I do not use the VIX notation in the Chapman wave, except in the daily and the 120-minute chart. Look at that powerful move from a peak D in the daily from 14.60 to today's low of 11.03. I mean, that is huge. That's 3 points. That's what, 30% or something. That's a big move down. So I use it on the daily, and I almost always use it on the 120-minute for my subscribers. So let's just keep it simple. The VIX going to the high 12s and the 13s, you start to see the selling increase again. At this particular point, there's still some buying pressure. Next question I had, which was a real good question, was, would I look at the EUR-USD? EUR-USD, and that is the, where did it go? Where did I type it? I typed it into the den by mistake. EUR-USD, that's the euro-dollar currency pair. I believe that it's made a peak F in the daily. But the MACD is still good. It's turned down, but still good. And the stochastic's pulling back. It's at 82%. It's not under 80%. It's at 82. So that says there's still some residual strength. My thinking here is that we're going to be able to make this into a larger arch formation. I'm just putting this in now to say that's what I'm thinking. You remember I talked about that lowercase h that goes to an M pattern, lowercase m pattern in the monthly. I think it's just stuck in a range. So Euro has 1.07 as a really important support. 1.072, it's at 1.075, and it has 1.083. If it goes above 0.84, that's going to be very good action. I don't know what's going to get it there, because what I'm really looking at here is that the dollar is showing some strength. Now, I had to put this into context today. I had to say, over the last 2 years, I've been looking at 3 years actually, I've been saying if the dollar shows strength, very often the market moves kind of in the same direction. I say kind of in the same direction. So I can't ignore the fact that the low that was made on Monday might turn out to be something more important. I absolutely will not rule it out, which is one of the reasons why I said we've got some new buys, stocks that are buys, just to be completely independent of the market. I'm trying to separate my thinking here so that what looks good, you can treat as a buy, and what looks poor, you treat it as a short. But what's really important here is that the dollar made a lower low. I do not like that. It's gone above that trough A. That says to me that the dollar should be in a chop range. Maybe it can rally some, but I would not be surprised if it's going to come back and have to test the 99s one more time. I can just tell you this, that the dollar at 100.06 up 35 cents. Nice candle last 2 days. It's holding its support. Let me see if the S&P is actually holding it on a visual basis. If you get it right, you can type it in the right place. SPX.X. No. That candle is very different. So the dollar is showing a little bit more strength. So let's go to gold, because I love to see them as counter trends, as if not one for one, but direction for direction. There's an inverse relationship very often. So I'm looking at this and I'm saying, look, gold has held very well, but gold stocks have not been holding well. And I suspect at 91% for the gold index, this is a continuous contract, and the MACD is still expanding. I like that. So I'm saying that gold, to me, gold itself, not the GDX, which is not doing all that well. We've got a reverse relationship. And now I'm going to go to Brent in California. Brent, how are you?
I'm doing well, Basil. Welcome back.
Thank you.
Good to have you back on the air.
It's good to be back. Let me tell you, I always enjoyed being back. Yes.
Okay. So what I would like to do, if you wouldn't mind, is to I'd like to look at oil kind of as the proxy for the stock that I'm trading, but I just wanted to get your opinion about that, because I started looking at that while you were gone at the end of last week, and then at the beginning of this week, and I took a position in DNR, which I have traded. I probably started trading that at the end of 2015. Going into 2016, when there was a bunch of commodity stocks that were beaten down,
nice.
and the oil sector in particular. And so, okay, well, we could talk about it after the break.
Yeah, so let me just say, DNR's Denbury Resources trading at $2.65, up 23 cents, up 9.5%. Whoa, good eye. We'll be back with Brent in California. We're looking at DNR. Dow's down 52, S&P's down. Now it's down. I'll be right back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Larry Peavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Peavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Everyone, we're back, and if you want to look at that 2-minute chart, I said it's got to hold that left side low. Didn't look like it was going to, and if it didn't hold the left side low, it would break and test, at least it would test the green line, which is 200-period moving average of 23.53. In fact, it ran down to 23.51.75, trying to bounce now because the stochastic says ready for a little bit of a bounce. So negative action, and we're on with Brent, breakout Brent in California. So... USO is acting very well. I looked at this real closely this morning. I, in fact, put in my newsletter that I was looking at an oil. I couldn't even remember if it was an oil refiner. I just remember seeing the chart over the weekend, and it kind of looked important that I keep an eye on it. And it's actually rallying quite nicely. So I'm looking at this, and I'm thinking, okay, this is one of those times where crude oil rallied. Let me see if crude oil actually is rallying. Crude oil right now, CL is, up 81 cents. And what's really important, it made a little double bottom, almost the same as your chart, and it's at 49.19. I still think this is kind of within the context of a bounce, a nice bounce. And so let's get back to our story. And what we're looking at is, I wanted to finish my sentence, which was, this is one of the few times where crude oil actually rallied, and the market, instead of rallying, is pulling back. And this kind of confirms for me what I'm looking at and saying that there might be fun buying at this particular point. My thinking is that there's probably more fund renegotiating. In other words, fund managers are going to add a little bit more to their positions that are working and take off more to the positions that aren't working, and it's going to create this choppiness with limited upside, with a little more, with lower lows. And that's why when you brought this to my attention, DNR, I'm looking at it and I'm saying, that was a really nice turnaround. The MACD and stochastic was showing tremendous strength over the whole of March, and the price made a lower low. That's a positive divergence. Number one, and number two is the candle of the 23rd, the little doji candle. It's the first candle that it's made on the lows all the way down, since there was this little funny candle with a little bit of a bounce back in January. This is the first time that you got some really nice action that says that doji candle could have been a reversal candle of intermediate term proportions. Although we're looking at a daily chart, intermediate term, by that I imply price movement to the upside, not so much in time. And look what we've gone. We've gone from 220, which was the doji open and close, 221 was the open and close, and you've gone from that level to 264. This is a huge move. So I love what I'm looking at. Now, the problem is with some of these charts that you've brought to our attention is that they have a sharp move, but the actual trend itself has not stopped from making lower lows and lower highs. And one of the reasons is I keep talking about this lowercase h pattern that goes to a lowercase m pattern in the monthly chart. And that's really so the larger tide, if you're a lousy swimmer like me, you can do the surfing because they're real quick waves that come in, but you can't hang around in the water too long. I could never play water polo. So this is what we're looking at. The larger tide says that you've got to treat these more as trades, but on price you could treat it as almost an intermediate term buy. If you're going from the 220 level to the 280, the next serious resistance, 273, 280 levels, next serious resistance, that's a big price move. That's the kind of price move you sometimes get over a period of weeks. So if you do it in days, that's really what I'm saying. So Brent, I'm going to say to you, I think that this move technically on the daily is the first sign that I'm thinking now the 239 9-period exponential moving average in the daily should be really strong support. In fact, it shouldn't even get there in the next day or two. It should hold at the 253 level, 252, maybe even 249. But I think 276 is my real upside target for this on the weekly basis, based on the fact that this is the second arch formation in the monthly chart, and it didn't break severely below the previous middle part of the arch of that was somewhere in August, I guess, of last year, November of last year. So I'm thinking that this one has a chance to make another nice rally, but I don't know if this is going to be the breakout. That's really what I'm saying. So I treat it as something that you do take some profits on. I would try my best once again to try to keep this as a core holding. If it's possible, it's going to tell you if it's possible. But I love the candle in the weekly chart of last week. And I love that little doji candle and the leg. This is actually a leg B. Did I put an A? I should have put a B. 215. Yeah, this is B. This is leg B. This is very nice. I like it. I do like it. I must congratulate you. You really have a good eye for just picking these things out within pennies of the bottom, but it's not the bottom. It's bottoms that have come from moves that are way higher, and then they've pulled back to levels that you seem to really grab them at the low. And I must congratulate you for your technique there. But I like it. I think it's good. I'm just saying to you that it's had the habit of rallying and then it fails. But the percentage move when it does rally has been pretty darn good. And that's where it's at right now.
Yeah, I think one of the keys, Basil, I try to do, and it took a lot of time to, and mistakes to get to that point, but just having patience is extremely important, and just not rushing into something and letting it come to you as much as possible. And it's not always easy to do, but if you can discipline yourself to do that, I think it's going to be beneficial.
I think you're missing a very important point. The point is that you haven't just had patience, and you haven't been just kind of sitting there waiting. What you've done is you've allowed some techniques within you to say, this is not the time. No, this is not the time. This is the time. And that is a technique that takes a lot of experience, and it takes a lot of, it does take mistakes, but what it does is it takes a lot of building of your mistakes to become more proficient at identifying it and putting in the trade. And that's really what I must compliment you on. You've done it very well, this one in particular.
Well, thank you very much, Basil. I always appreciate your help. It's great to have you back, and just have a wonderful day. I'll talk to you soon.
Thank you very much, and it's good to be back. Good to hear from you. Thank you. So, folks, let's just do this for a moment here, because I don't want to run out of time, just kind of to refresh. I've been away for a while, longer than I anticipated from the show. Let me just do this. I want you to explain to you why my thinking is what it is. And that is, we still remain short our positions in the indices. And one of the reasons is that within the context of the market, if you see this strong this red trend line, this is the 20-period exponential moving average. That's the think reddy pinky line. If you're looking at this is the 9-period exponential moving average. The blue, look, this is the first time the blue's been holding underneath the red. That's a big difference between 9 and 20. The other thing is we have been making the arch formations. In the Chapman wave, we look for the lowercase h pattern. There it is. You come down, have a bounce, fail, take out the left side low. Rally, fail, take out the left side low. Rally, I don't know if we're going to fail. Now, I don't really like to talk about this, but since you can see it, I may as well talk about it because, after all, that's what we're here for. A technique I've worked on for a long, long time is that in the Chapman Wave 5, I do not use Elliott Wave specs because I found that for my work, I can use other things. So I'm going to explain that. As we come back, I'll show you why I think that this is Wave 4 and that we're going to have Wave 5 to come down, one more low. And that's really what I wanted to talk about. I'll be right back.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Learn how to trade options with Swim Lessons. Brought to you by TD Ameritrade. Think or swim. Next on TFNN.
All right, so let's just get to it in the remaining few minutes. The XLF, this is the financials, the S&P Select Spider, Financial Spider Fund. It's had a big move down. It's one of the biggest moves down it's had in quite a long time. In fact, one of the biggest move it's had since the high that was made back in May of 2016. I think it's trying to form some kind of a base. The pattern I see says that, yeah, we could make another bit of a right shoulder in the weekly, then retest the 2320, 2190 level. But at this particular point, I think I'm a little concerned. The peak D in the weekly with a silent doji the week after, the week of the 10th of March, says to me, hey, it's not quite ready. It's had a spectacular move, going from the 16 level in 2016 to the 20, over 25. I mean, it just needs a rest. Oh. So that's XLF. If it had to break, it's a 2366 down 11. If it broke into the 2450 area in the next week and a half, I'd have to say, you know what, I'm completely wrong. We're done with the correction. It's on its way up. All right. Here's the other thing that I must point out. I sent this to my subscribers this morning. I think that the yields, the 30-year, the white 30-year TYX, the brown 10-year note, T-note yield, the TNX, and the FVX, the 5-year cyan-colored one, I think that's a double top. That's the Chapman wave drop bucket formation. I'm going to be watching this real closely. I think that was a top of significance. I think yields are going to be going down, and bonds could rally. The TLT is, in fact, up 43 cents at 121.05. It doesn't have to rally much. I think it's more in like a trading band right now, but it's really important. I'm watching wood, WOD, the iShares Global Timber and Forestry. Weekly peak D so far has made a new high, and the high HDX, the Philadelphia Housing Sector Index, I think there's going to be a peak F, but I'm holding tight here, just looking at it. But these things are just indications to say, be a little bit careful here. Then we go to the IYT, which is the Transportation Index. IYT has had a very nice move from the low. It was made in the 158 area. Now it's at 163. Nice bounce, but look at the weekly chart. That is a weekly sell mode. It's not a sell signal, it's a sell mode. Let me put the down arrow. So when I put this all together, it just says, I believe that the upside is limited, that select stocks are still doing okay. I had a question today about, here we go, Apple, Microsoft, Amazon. Look, Amazon new, I believe, all-time high. Yep, all-time high. I haven't renotated it, but this is A, B, C, it's in leg D. Leg E in the weekly chart still acting beautifully, and that's the reason why I think that fund managers are buying. They're getting out of the stuff that hasn't worked for them, and they're adding to positions that have been working. That's right. That's my point right now. Question about XOM. This is Exxon Mobil. Is this a buy? Are these lows? Well, you know what? I think if you want to treat this as a dividend stock, finally I can say to you, CVX. Now Exxon's acting a little bit better than Chevron. And I don't know if I treat it as a dividend buy, but I'd say your risk reward here, if you bought it at 82 with a stop 2 points lower at 82.14, make a stop under 80.31. At 80.14, I think you can treat this. So 2 points down is 3.5 maybe percent, and you're going to be getting 4.5%. So you could use that risk reward. I'd say this is the time. I'm not expecting spectacular move to the upside, but I do say, yeah, maybe this is the time to be looking at it. Telephone, I don't think is quite working. Verizon is not quite working. So I covered that. Next question GT wanted to know is, yeah, I just did that. So this is the yield. Let me just do this TNX.X. This is the 10-year yield. Yeah, look, the 10-year yield is just kind of stuck here. And I don't think it's going to go very far. It's at 23.93, 2.39. So let's keep it real simple. The market is choppy to the downside with lower lows and lower highs. I think that it's going to take a lot of effort to break the low that was made on Monday, but I think we will test that, and we'll test it fairly soon. But in the meantime, be selective. You can choose your stocks carefully, but at the same time, the indices, I think, have to test lower lows. That's my thinking right now. I'll be back tomorrow. Have a great day.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.